What's up, guys? Eric here, Mr. Fired Up Wealth, and today I'm going to bring you my top 3 favorite dividend growth investing for fired, that's DGIF stocks, that I like from this price through 2021. So these aren't the top 3 stocks that are going to dominate your portfolio necessarily, but I like them priced where they're at right now, and I do like them as long-term holds. And there's 3 stocks that I think will perform well in 2021. Now, if you're not familiar with what dividend growth investing for fired is, that's a stock that's going to give you stock appreciation, but also growth on the dividend. So you're going to use that to outperform and still get some dividends, but you're not looking at income stocks like an AT&T or an Altria. You're looking at something that's going to give you performance on both ends. Now, today I'm going to cover a mega cap stock, a mid cap stock, and a small cap stock in my top 3. So you're going to want to see this video. Stay tuned. Okay, guys, so this first stock is going to be Apple. And before we go on, people are going to say, hey, why isn't this stock on here? Why isn't NVIDIA on here? Why isn't this on here? I'm trying to pick 3 stocks that I think will do well, possibly from this price, and continue to do well in 2021. I'm finding 3 stocks that I think are priced somewhat attractively and that I think I have a bull case for the next year. Now, Apple, I can definitely argue, is expensive, especially by historic means. It's trading at a 37.5 PE ratio, and typically it traded much lower than that if you go back and look at a chart, a 5-year chart. Of course, we had a split on Apple, so you have to keep that in mind. But this thing was trading much lower and at a much lower valuation. Now, why is that? We'll get to it in a second. So this does pay a small yield now at 0.67%. If you remember, not that long ago, a year ago, this was paying closer to 1.5%, and the PEG ratio is of 2.97. You usually like to have that number be a little bit better. So why do I think Apple will go higher from here? Part of it's technicals, part of it's fundamentals. The fundamentals are always going to be most important for me if I'm long-term investing. And so let's first look at the fundamental reason why Apple could go higher from here and have a good year in 2021. Now, with all these stocks I'm covering today, if you can get them cheaper than they are, of course, that's going to be better. So I like the dollar cost average into these stocks. Now, with Apple, if you were buying this, you probably would have been buying it when it was a little bit lower. It's made a little bit run. But I'll show you a chart here in a few minutes where I think it actually could continue to go higher from here. So it can be tricky because it's hard to dollar cost average. If the stock is continuing to trend higher, you might have to be a little bit more aggressive on your percentages if you're doing my standard dollar cost averaging, if you've been following the channel for a while. So Apple One is really important to their business. If you think of Apple, historically, it's been, a phone, phones, primarily phones, computers, tablets, things like that. But if you go back, before 10 years ago, it was the Mac and then the phones. And then when they first came out with the iPad, I said, why would I want an iPad? I travel for business. I've got my laptop. I've got my iPhone. Why in the world would I want a third device? That's just silly. Well, a year later, I was carrying all 3 and I loved it because, on the plane or from in the hotel room, I loved having that big iPad to be able to, to surf the web and have a little bit more screen space and, be on the run and have a little bit of screen space, not have to carry the big computer, but have a lot more space to work with. I've got big hands. So Apple One is important because it's now converting Apple's model more into a services. Think of like software as a service, subscription model, recurring revenue. That's the theme that you see a lot, especially if you follow my channel with these SaaS type plays. Not saying this is SaaS, but it's very similar in the terms of recurring revenue and subscription-based revenue. So it's very attractive for investors when you go to that model because it's very easy to have insight into where the sales are going to be for that particular product set or service set. So if you look at Apple One, it's amazing. You've got Apple Music, you've got Apple TV Plus, you've got Apple Arcade, you've got the iCloud storage, you've got Apple News, and coming soon, they've got this Apple Fitness for Apple Watch. And there's been speculation on that if maybe Apple is going to get more into the Peloton type services and things like that. So it's definitely something to keep an eye on. Now, if you look at this, they've got the individual is $14.95 a month. That includes music, Apple TV Plus, Arcade, and 50 gigs of iCloud. That's not a bad value. There's a family plan that's going to save you $8 a month, and you can share with up to 5 other people. Music, TV Plus, arcade, and 200 gigs of iCloud. Now the Premier has music, has TV, has arcade, has 2 terabytes of cloud storage, has News Plus, and it has Fitness Plus, which is coming. It says late 2020, and it's middle December, almost early December. So it should be coming here very soon, before the holiday season here kicks off. But this is going to change the game for Apple. It's why a lot of investors are excited. The split did make a difference. It should not matter in terms of, if you take a pizza, you have one pizza and you cut it into 5 pieces, it's still one pizza. But psychologically, a lot of investors do like to buy. You saw it on Tesla, and you've seen it time and time again. When there's a stock split, it's just cheaper to own more shares. And psychologically, a lot of people, think they're getting more of the pie, but they're not. The other thing it does do, though, that it significantly does impact is options. To do an options contract, you need to have 100 shares of a stock. And if the stock is less expensive, it's easier to get to those 100 shares to do a contract. So with Tesla and with Apple and a lot of these, when they do the splits, it can actually impact it in that way. But this is something that I think is going to change the game. And then on top of it, you've got the 5G super cycle. So you think of all the new phones, the Apple 12, iPhone 12. Let's just take a look at the new phone. They've got, it's a leap year, iPhone 12 Pro, and you can see you can actually trade in your old one. So here's the models. They've got the regular iPhone from $399, the iPhone 11, iPhone 12, iPhone 12 Pro. So the iPhone 12 Pro is going to be $1,000 starting, and depending on how much storage you get, it can actually get pretty expensive. Let's just take a look at this and see what this would cost. So let's just say I do an iPhone Pro Max. I'm going to do graphite. I'm going to do AT&T, and I'm going to do 512. Do you have a smartphone to trade? I'll say no. Pay in full. $1,399. So $1,400 for this iPhone. That's certainly going to drive sales. And then if you add, the subscription on top of it, I do think that Apple is going to have a good year next year. I think a lot of people are waiting because of the pandemic to do the upgrade with their phone. So they might do it around Christmas. They might do it in January, but not as many people are going to go out of the house and actually just go upgrade their phone. So I think there is a little bit of lag in that. The last earnings they did, there was a little bit of disappointment that there weren't more iPhone sales. I think it's because people are basically waiting, and you're going to see more of this. So next time they report, I think you're going to see a pickup in the iPhone sales, and I think that's going to carry on through as the pandemic lessens, as the vaccine comes available, et cetera. So that's your first stock, Apple. Okay, so I won't forget the technicals. I promised you to look at a chart. Now, this is just from TradingView, and I'm using the pivot point. So if you come into tradingview.com, you can set up a free account. They've got some paid accounts as well. It's a good service. I do have a premium account with TradingView, and I use Fidelity Active Trader Pro, and I like to show those charts as well, but it's good to mix it up, especially for those of you who don't use Fidelity. Pretty much anybody can use TradingView. So on tradingview.com, if you go under here under templates and you go into swing trading, you can actually do this yourself and look at the zigzags, the pivots, etc. Now, these aren't always right, and you certainly can get in trouble if you just try to buy and sell stock based on this graph in front of you. This is basically one part or one tool in a toolbox used to make a decision to buy or sell. And everything I'm talking about on my channel is going to be for long-term investing, not for day trading, things like that. Sometimes we do some swing trades, but we're generally holding this for long periods of time, 1 year, 2 year, 3 year, maybe longer, and possibly even dollar cost averaging depending on the situation. So now this one, it would have been much better to buy this, at $116 a share, of course. That's obvious. You can always say that about any of these stocks. Well, I should have bought it back here. I should have, could have, would have. Now, this was $137 though, and it did pull back, and it would have been good to buy it when it got closer to that, $105 range. You can see, we basically bumped off this 103.10, 107.32 here. Now, this could go one of two ways. It could trade within this zone. It could come back to that $116. There should be some support there at that $116 and whatever that is, $116.70, 34 cents. And we probably see some some resistance where it's headed right now around that $125 mark. Now, if it breaks past that 125 mark, I think you easily, could trade higher. It could actually go to an all-time high from here. So I'm not guaranteeing either direction. I think statistically, when you look at it, there's a good chance that we do break out. If the greater stock market holds up from here, you should see this stock continue to do well, Apple. If the market sells off, of course, all bets are off. When you're talking about technicals, if the entire market sells off, it's going to pull your stocks down and it's going to break technicals. And just, that's why it was such a mess back in March and April. Everything got sold off, just hit the panic button, sell everything at once. All the technicals were broken. It took some time for that to kind of work itself out. So assuming that the overall market doesn't collapse, this should have support in this range. If you can buy it between 116 and 125, it certainly could break out past that 125 and go much higher. It could go as high as 138 where it was, even do something like a Fibonacci extension where it could go above and beyond that $138 all-time high that it had. So you could see it break up into this, $140 to $148 mark. And on the very high end, you'd probably see something closer to 160. If you're holding this long-term, it should continue to do well. As we showed earlier, the PE is kind of rich compared to historic valuations, but the company is slowly changing itself. It's changing itself more into a services business and not just a consumer cyclicals type business with the phone. When they just had phones and just had hardware, it made it very much a consumer cycle. Now they're making it more into a subscription revenue business, like we talked about earlier, and it's going to really change, Apple. They're also talking about doing more and more of their own chips. Currently possibly displacing Intel and working with ARM, and ARM is the company that NVIDIA is trying to acquire right now. If that gets passed, it should happen in 2021. So Apple would essentially be a partner of NVIDIA, assuming that all this stuff comes to fruition. So something to keep in mind, but Apple is being more aggressive, trying to take the bull by its horns and actually be more involved in the hardware development to save costs and things like that. So a lot of people will say, should I buy this chip stock because, or this hardware stock because they sell components to Apple? It's always dangerous. Me personally, I'd rather just own Apple, because anytime you own a stock that's reliant, heavily on one business, like say 50% of their business is to Apple, that can be really dangerous as an investor. So for me personally, I'd rather own Apple. Now I've had Apple for quite a while. I'm going to look at, I have another screen over here. I'm going to look and see. So I have 359.62 shares of Apple, and my purchase price is $33.43. So, I've had it for a while. Nice gain on it, but I do continue to think it'll go higher. I'm going to hold it. I'm not adding to it. I'm not selling it. I'm simply holding it for this 5G super cycle and to see how the company reinvents itself as a services play. All right, number two, I'm going to throw a little bit of a curveball. If you're not in Discord or Patreon, you might not have ever heard of this company before. It's called Tractor Supply Company. The ticker is TSCO. Now, this is one that I do like as a dividend growth investing for fired play, DGIF. Now, the stock has made a big run. We'll look at some charts here in a couple minutes, and it got ahead of itself a little bit. But it's something I do like long term. You have to remember that this stock is also somewhat cyclical, so it's going to be busier at certain times of the year. So when you think there's winter in the United States, those are going to be slower months. So you're going to see your busiest quarters are going to be generally during the summer months, and it's not always the best time to buy a stock like this going into the winter. So keep that in mind. It's something that you'd be buying and basically dollar cost averaging in over the course of time. And basically by this time next year, the hope is that the stock is quite a bit higher. Now, with all these stocks, these are not growth stocks. So I'm not trying to find you the next 100% or five bagger that's going to happen in 2 months. These are dividend growth investing for fire. They're going to give you a little bit of dividend. They're going to give you some modest growth on the appreciation of the share price, as well as the dividend continuing to increase each year. And the idea is that you're going to have compounding, and that's going to work in your favor over a long period of time. So, if you're a young investor, I prefer a DGIF type style stock versus just something that's more like Altria, that's more of an income stock, if that makes sense. So Tractor Supply Company is one it has really explosive growth. They've been trying to grow more and more locations. The finances are strong. Like I said, it did get ahead of itself. A lot of people are considering it maybe a COVID play. So thinking that maybe that the volume and the activity and the sales, the revenue is going to decrease on something like this as the pandemic subsides. I tend to think that there is some of that in there, but I do think that this company is positioned well. When you think of Home Depot and Costco, for example, I own those. You think of, let's just use Minneapolis because I lived there for 18 years and I understand that city. You think of like all the suburbs. So you've got Plymouth, you've got Eden Prairie, what have you. They've got Costco's, right? They've got Costco's that you can go, the Plymouth one's technically St. Louis Park, but they're right next to each other. But they've got Costco's, you go Home Depot's, different places you go in Bloomington, Eden Prairie, whatever. Those are going to cater more to like that tier 1, tier 2 suburbs, right? When you think of a Tractor Supply Company, it's going to be when you get a little further out. So maybe tier 3, heading out further that way. So the best way I can put that is it's a little bit less expensive for them to build their buildings because they're paying a lot less for that land. And it's allowing people from tier 1 and tier 2 to drive out to tier 3 if they want to buy something from there. It's also giving the people that live further in the rural countryside around the bigger cities, allowing them to shop at these places. In addition to that, they do have a lot of locations that are in those smaller communities that might have, say 50,000 residents, what have you. These guys do actually own a chain of pet stores as well, which is interesting. Let's just look at some highlights of this. So if you look at, this is Q3 2019, and we're comparing it to Q3 2020, they had 31.4% net sales growth in billions. That's, pretty impressive. Comp sales growth, 2.9 to 26.8. That's where you say, well, that's all from COVID. Some of it probably is from COVID, but I do think that this company has been positioned well even before the pandemic. And a lot of these, like it says here, new customers and re-engaged customers, as well as existing customers. So in Q2 and Q3 of 2020, they attracted 10 million new customers and they re-engaged old customers. And they had existing, customers that they consider maybe loyal, that have this Neighbors Club member program, about 17.8 million. So that's pretty significant, adding 10 million new customers. Even if only half of those customers, say 5 million of them, continue to go there because now they like it, it's a habit. That's going to definitely drive the bottom line for the company. So you look at their gross margin, they've expanded 35% to 36.4. They've done a great job in a lot of these areas. I don't want to bore you to death, but this is important if you're a long-term investor to look at these fundamentals and understand what you're investing in and what the companies are doing on their books. So their operating margin, went from 8.2 to 9.7. Earnings per share is up 58%. Net income's up 56%. Profitable company. Outlook for 2020 Q4, they got net sales of 2.6 to 2.7 billion. Comparable store sales of 15 to 20%, which is a really good number if you're looking at comparable store sales, if you're familiar with how these brick and mortar companies work. And I'm not a huge brick and mortar guy. I mean, you can look at my portfolio and I've got a lot of, the work from home type stocks and the Amazons and, very much SaaS and software types of companies that I've been investing even before 2020, before the pandemic. And, if you look at a company like this, I typically don't like brick and mortar businesses, but this does make sense because of the clientele they're targeting. So it's not just tractor parts. I mean, you basically take like a Home Depot and maybe like a Cabela's, like a hunting type store, and then like tractor parts and then a pet store and kind of mix them into one company. So they have they sell kayaks, they sell sporting equipment, just all kinds of things, lawnmowers you can see there, snow blowers, different things like that. But a lot of clothing, surprisingly, there's just a lot. So take a look at the website and actually look on Tractor Supply Company. You'll see that they do have a very diverse range of products that they do sell. So gardening is obviously big for them. And of course, during the winter months, gardening is not going to be nearly as popular. You've got your hunters that like to go there, the barbecue type crowd that want to buy supplies for barbecue. This is really cool. I'm going to make sure you can see this. So their mission: to work hard, have fun, make money by providing legendary service and great products at everyday low prices. And to their stakeholders, we are a growth company that delivers a strong total return to our shareholders, as well as for our vendors and our partners. that sounds good to me as an investor. I do own some of this, guys. How much Tractor Supply Company do I own? I'm going to look at my monitor over here. These new curved monitors have been awesome to work with. I own 65 shares of Tractor Supply Company. I wouldn't mind adding a little bit more, maybe at least 35 to get to 100 shares, maybe even more than that. So it's not a huge, part of the portfolio. It's I would do a max of 1% in my portfolio kind of a thing. But check this out. So a strong track record of performance. Now this is from store growth from 1995 all the way to present day. And you can see they've grown consistently, even before the pandemic. They've grown a lot and very consistently over the last 25 years. You can see they hit $5 billion in sales in 2013. They hit their 1,000th store in 2011. So lots of great stuff, broad-based top line growth, consistent positive comp store sales, disciplined leverage, strong free cash flow generation, operating margin improvements, 10 years of positive traffic growth. These guys have been on fire for a long time. I think some of these customers are going to be sticky. They're going to realize, hey, this is actually a pretty good store. Why didn't we come here before? I think you are going to see a little bit of that. You might see some fall off, which is why the stock has been kind of churning. Right now today it's trading at $135 a share. It ran all the way up to 157. That was the all-time high. But if you look at the 52-week range, it was $63.89 was the low on it. So it's come a long way, like a lot of these stocks have. So here's significant opportunities for new store growth. So they currently, as of September 26, 2020, have 1,904 stores, and their opportunity, they'd like to get to 2,500 stores. So they do want to continue to grow, and as a shareholder, that's what I want to see. There's a lot more information on here. You can go through their management team. They've got experience from, Home Depot, which is important for me, McDonald's, Walmart, Ultra Beauty, Target, a lot of great names in here in retail and things like that. But, you've got 15 years, 21 experience, very solid management team, very experienced management team. I've done a little research on some of these folks on LinkedIn and things like that, and I didn't see any red flags in the management team. Looked pretty promising to me. Here's their Life Out Here strategy: deliver legendary customer experiences, advance our one tractor capabilities, operate the tractor way, go the country mile for our team, and generate healthy shareholder return. I love that part of their mission always is to make sure that they're taking care of people, but they're also doing well for the company and the shareholders. And I like that balance. Sales per square foot versus select retail peers, they're doing well. They're doing really well. This is Tractor Supply Company. So, they're trying to constantly improve that. They're trying to drive space productivity, all these different things they're doing. So season divisioning store cluster. They use technology and analytics to, here's all their stores too. This is kind of a neat shot here. So, I was talking about Minneapolis before, like here's the Twin Cities. You can see they're basically tier 3, right? And they've got some spread out in other areas. You go down south, there's a ton of them, but they're almost in every state. They're all over the place. Looks like they're in pretty much every state. So lots of stores, and they're continuing to grow. Locally great, nationally strong. Here's Project Fusion, talks about some of their growth initiatives. Here's Accelerate. They want to grow 150 to 200 stores next year. Here's how they transform their side lots to be more productive and sell more. Different strategies they're trying. There's their side lots, so people can, contactless. They can drive up and grab their stuff on these side lots, and they're doing things to try to, to help generate sales during this time. Significant opportunity for improvement. Focus on labor-intensive processes. They do a great job. I'll just scroll through some of these, and you can take a look at the links on your own. But here's some of the team members. I did a lot of research too on Facebook and things like that before I bought it. And there's always going to be a few people that complain here and there. Obviously they've got a lot of work to do on the e-commerce percentage. So, they can certainly improve in that space. But, I looked, and there's always a few people that are not happy. You can't please the world. But there's a lot of people even on the Facebook posts that are like, I love my Tractor Supply, store. I love, they have price guarantees for dog food and things like that. So I know a lot of people like to order online, like Chewy or even Amazon for dog food. If you're going to go there anyway, and you got to get, some parts for your tractor, if you're going there to get, whatever you're going there to get, it's nice because they can kind of, they can add on some additional sales with things like that. So that's kind of just a quick snapshot. If you're interested in the financials, I mean, here it is on your screen. Have fun with that. Next, I'm going to give you a chart on the technicals. Okay, so looking at the technicals, you know, the RSI is at a 49, so it's pretty neutral. Now, this could actually come down to maybe the 200-day moving average. You know, if you look at the simple moving average, it's 123.90. It's trading at 135. So, you know, I think anything in that range, if you could get it between 123 and where it's at now, 135, and kind of dollar cost in. The PE ratio is at 20.86. The dividend's at 1.19%. It's a $15.78 billion market cap. It's got $6.50 for the earnings per share. So yeah, it's a good company. It's not that expensive at a 21 PE ratio, and I think it still has upside from here, especially in 2021 as we get more into those seasonal sales and they kind of prove themselves. Here's a quick chart using the same TradingView chart with the grids. So I'm just going under templates here, and I'm doing the swing trading grids. You can use whatever you want, and you can change, you know, if you want to look at year chart, if you want to look at, it's going to change depending on what duration you use and things like that. I like using the year to date because we're almost at a year. Typically you'd use a 1 year chart. It's not going to matter much in this case because we're in December. But this is trading kind of right in that resistance line, say 136, you know, 136.74. And it's trading in a pretty tight range. So a lot of times when you see consolidation, it's like a rubber band. You know, it coils up real tight, and then it's going to pop one way or the other. Probably in this case, I would say it's going to pop up and not down. And so it might continue to bounce around between these two levels. You know, this is actually even tighter than when we talked about the 200-day a second ago. So this is, you know, trading in that 131.98 to 136.37, very tight range in there. If it drops down, this is going to be your 200-day, close to that 123.50, you know, in that range. So, I mean, there's a little bit of downside risk maybe, but if you're kind of dollar cost averaging in, if you can get it anywhere in these tiers, I think it probably by next year, you know, a year from now, 12 months from now, that we're trading back at all-time highs, probably between $160 and $180 a share would be my guess. So again, it's not a hyper growth stock. It's going to give you a little bit more growth maybe than the S&P 500. It's going to maybe diversify your portfolio into a different area that you don't have anything in your portfolio in. Some brick and mortar that, in my opinion, is sticky. You know, you can't. Some of this stuff you can't deliver. You know, like some of the tractor parts and things they sell. It's pretty hard. You know, if you have a breakdown, if you're familiar with farming at all, if you're in the farm and your tractor breaks down, and you need a part. You're not going to want to wait 2 days for FedEx or UPS to bring it. You're going to drive to the tractor supply company shop. You're going to buy your part. You're going to go get it fixed. So it's been a while since I've been in the field, so don't quote me on that. But you know, when I was a kid, I worked with my grandpa, and anytime we'd have a combine or something break down, we'd have to, you know, rush to in that case, it was the John Deere outlet or whatever. But you know, Tractor Supply Company does carry a lot of those parts. But again, it's not just tractor parts. It's all kinds of stuff from gardening. You know, think of like a Home Depot mixed with maybe a, you know, Target mixed with like a Cabela's mixed with, you know, Tractor Supply parts. So it's a pretty interesting company. It's not going to be for everybody. I realize some people are going to watch this and laugh and be like, who's this guy? Why is he telling me to buy a Tractor Supply Company? I'm just showing you the 3 stocks that I think have a great chance to do well in 2021, that pay a nice dividend, that are considered DGIF, that's dividend growth investing preferred. You can buy whatever you want with your money. This is one that I like, and I've been adding to it, and I probably will be adding some more if it dips down a little bit more. Okay, last but not least, this is pronounced LMAT Vascular. The ticker is LMAT. Before I cover LMAT, I want to stress that this is a small cap stock. It has more risk. Anytime there's a stock that's this size, that's small cap, it carries much more risk. It doesn't have nearly as much volume. For example, today, what do we have? We have 23,000 shares traded today versus Apple that traded 47 million shares. Okay, so understand that this type of stock has a lot of risk. It also has, in my opinion, more reward upside in a lot of cases with these smaller companies because they have a lot of room to grow. So this is a DGIF that I like. I've been talking about it for a while as a rebound play in Discord. If you're not in Discord, you should consider joining, because I was telling people when it was at $30 that it was probably going a lot higher. It's now trading at $38. And the all-time high is actually $41.86. Now I do own, what do I own? I own 100 shares, 100.54 shares, a little over 100 shares because of the dividends being reinvested. I own 100 shares, and my purchase price on this is $26.22. So it's obviously a lot, higher. It's 45% higher. This was in my DGIF series that I did, I don't know, a year or so ago. The top 60 dividend growth investing stocks were fired. If you haven't seen that series, check it out because there's a lot of great information on that. It's actually 5 hours of content in that series. So take a look if you really like to go deep dive on these stocks like we're doing today. So LMAT is it's an interesting company. They've been growing. They've been growing well. They do a lot of growth through acquisitions. This is going to talk a little bit about sales by specialists. They do essentially it's medical devices for, heart attacks and cardio type work. So they do biological implants, they do disposables, things like that, but it's usually going to be vascular related. It's not just heart, but anything with veins, anytime you have to do any kind of surgery. So catheters, they do grafts, and they're selling this stuff globally. You can see the growth has really been in the biological implants more and more. You can see, here's their worldwide sales reach. They've got 35 sales reps in North America, 33 in Europe. They've got 11 reps in Asia Pacific Rim, and so on. Looks like there's one in Singapore. There's 79 sales reps. So it's not that big of a company. Here's all the regulatory approvals, direct sales channel, all the different products they can sell in different regions. A lot of good information on these slides. I won't cover a lot of this in detail because I know a lot of you probably, have never heard of this company, and you probably don't care so much about some of these granular details. But 24 acquisitions in 23 years. So it's one of those companies that likes to do acquisitions, and they've grown their sales significantly through acquisitions. So if you look at non-acquired sales, it's actually flat to declining. Their acquired sales is actually increasing, and their growth of acquired sales is increasing. So this company for the last 23 years has relied on acquisitions. It's becoming larger and larger and more well-known. I have a couple of buddies that work in this space that sell to hospitals and things, and that's how I first learned about the company. And, it has obviously some risk with it. It pays a decent little dividend on it. It's doing well in terms of free cash flow and dividends paid, the liquidity, all those different things. It's just a quality company. It doesn't have, a ton of red flags in terms of the financials or anything like that. Let's just look really quick on Fidelity here. So it pays you a 1% dividend yield. You can see right here, it's a 40 PE ratio. It's only up 4% 52-week. You can see a chart here where, it's kind of over the last 5 years, it's kind of done some ups and downs. But over this past year, if you look at a 1-year chart, it hit rock bottom here at $22, and it's kind of slowly, climbing up. The reason I'm recommending it today, or, again, I'm not a financial advisor, I can't really recommend it, but the reason I'm bringing it to your attention is I do think the stock has a lot of room to go higher. It is trading at a 40 PE ratio, so you could say it's expensive, but it has pulled back from that $42 all-time high, which just happened here in November 25th. And I think it's probably going to consolidate for a little while and be an opportunity and then probably push higher. So I wouldn't go all in or anything on this stock, because it certainly could go lower. I'll show you a technical chart here in a second with some of those pivot points. Okay, so if you look at this, we actually broke this pivot line here of $37.57 in that range. It looks like $37, $38. So we could easily trade down lower to maybe $33.99. I would be buying probably more if it got back to that range personally. I do think anywhere in this range that there's a good chance, it might come back down to this $34 line, but it's probably going to continue up. And you can see there's quite a bit of room on this. When you look at an R5, it goes all the way to $64. So I do think that in a year's time, if the company continues to do well, and as the vaccine rolls out and things like that, I can see this company trade more in this, $50 plus range. So it does have some upside, even though, it is a 40 PE ratio. It's done well over the years. It pays a nice dividend, 1%. It's not a lot, but it's that dividend growth investing for fired. The payout ratio on it's not too high. And they've proven themselves over time. And it's one I'm surprised that more people don't jump on this stock. I mean, like I said, there's only, what did I say, 24,000 shares traded today. So it's just not a company that people know a lot about. So you got Apple, which everybody knows about. You got Tractor Supply Company, which a lot of people probably don't know about, even though it's a pretty decent sized company. And then you got this small cap LMAT. All three of them are what I consider dividend growth investing for fired. So dividend growth investing for fired, you're going to have the appreciation in the value of the stock as well as appreciation in the dividend. There's actually 5 different factors or 5 different qualities that a DGIF stock must have. One of them being that the dividend payout ratio is 50% or less. You want a dividend of 3% or less. And if you're interested in what all the other 3 are and how all those components work together for a strong dividend growth investing for fired stock, I encourage you to take a look at the Dividend Growth Investing for Fired series. There's 60 stocks on there. There's actually more with the bonus. There's about 5 hours of content. I'll put a link. Go take a look at that. But that's part of my portfolio, the growth portfolio. I've got growth stocks. I've got dividend growth investing for fired. I've got ETFs. I've got spec, and I've got cash. So hope this video was helpful. I appreciate you guys watching. If you haven't subscribed, please do hit the subscribe button. Check out Facebook. We have a free group on Facebook. We also have a Patreon you can check out, Fired Up Wealth Patreon, if you're interested in diving deeper or joining us in Discord. I also have a masterclass. So if you join Elite or VIP, you get access to my masterclass content. I also do a daily live stream every morning. It's generally 30 minutes before market bell. So that's at 9 o'clock a.m. Eastern, Monday through Friday. We also do Friday afternoon live streams, and we do periodic live streams throughout the day. So we have a lot of fun as a group. There's 230 patrons in there now. Keep that group kind of small. At a certain point, we're actually going to probably just close it all together and cap it off, because quality is the most important thing to that group. I want that group to remain high quality, and we're growing it very slowly and organically. So if you're interested in joining us in there, we'd love to have you. Check out Patreon, Fired Up Wealth. But again, thanks for your time and attention. I hope you have a great rest of your day. Take care.